And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. I'm your host, Lance Roberts, and of course, Brent Clanton, as always, driving our Length Challenge bus. The couple of things going on today. We got to switch up in our normal programming. Michael Leibowitz is going to be out of the office on Thursday, so he's going to join us today. So we'll talk about the upcoming Fed meeting, the FOMC meeting, what the Fed's going to say. We're going to cover that today. Today, normally we cover the article that we put out, which is on buybacks. And so today's article on the website, if you go to realinvestmentadvice.com, has an article covering the importance of share buybacks. And share buybacks have continued to accelerate in size this year. Goldman Sachs estimates that we will surpass $1 trillion of share repurchases by corporations. Think about that for a moment. $1 trillion in a year of share repurchases. That's why the market's going up. And again, there's a very high correlation historically, an 88% correlation between changes in buybacks and the stock market. So when you have a period of buybacks where companies are buying back shares of stocks, asset prices rise. Now, if you remember, in October of this past year, the markets had been correcting. We were down about 10% towards the lows. I wrote an article that said, more October weakness before the year-end run. That was the title of the article. It's on the website. If you don't believe me, you can go look it up. But in October, we wrote this article talking about 3 reasons for a year-end rally, which was extreme negative confidence by investors. They were very bearish. At that point, also, we had big deviations from moving averages, so technically the markets were very oversold. And we said that the buyback window would reopen in November, providing that buyer of asset prices. And since then, we've had about $5 billion a day in share repurchases, and that's been driving a lot of this. Historically, going back to 2012, that was really where buybacks really took off in the overall markets. We've been having a period where corporate share buybacks have outpaced all other asset flows. In other words, corporations have been the net buyers of equities once you strip out everything else that's going on. So again, this is why we've had a very strong advance in markets over the last several years. But importantly, this big rally we've had here has been a big function of buybacks. Why am I telling you this now? Is because the buyback window closed on Friday. So we're now in that blackout period. So corporations can't buy shares back prior to this window before they start earnings announcements, which is coming up. So then we'll have buybacks will actually kind of be blacked out for about a month or so until after they announce and that window opens back up again and they can start buying back shares. So the reason I'm telling you this is because of this high correlation between asset prices and buybacks. With that window closing, that may provide some of the air pocket that is needed in terms of buyers to allow a bit of a correction here. Now, we haven't had one yet, And again, if we just, as we've talked about previously, this market continues just to remain very bullish at this point. There really doesn't seem to be a lot that can knock it down. But, a big part of that has just been this consistency of buying by corporations over the last, few months. So again, that article's on the website now. Goes through all the data, all the correlation stuff. It's all there for you. We've done a bit of we did a bit of historical review on stuff we said previously, just catch you up to date. But this is what's going on in the markets right now, and something at least. And again, we're not saying, hey, this is we're gonna have this big crash. I'm not saying that at all. But if you're looking for one of the reasons why markets could have a short-term correction, which are needed, we have such a big deviation from long-term moving averages. You need some type of correction here. Just a healthy pullback would be good for the markets and allow the markets to continue on from here. But that lack of buybacks may provide some of that potential for that correctional period because you're removing a major buyer from the asset markets. Okay, here's what you need to know before the bell this morning. Again, as I said yesterday, the market just continues to bounce along this 20-day moving average. Every time we touch that 20-day moving average, the algos step in, start buying shares, pushes the stocks back up to the top end of that trading range. That story hasn't changed at all. Yesterday, markets rallied a bit, right off the 20-day moving average, just as we have been watching just repeatedly ever since November. We've now gone 250 days without a 2% correction in the market. So it's been a very complacent rise in the market. Lots of speculative activity, lots of bullishness. Again, nothing wrong with that. And it's interesting now because as we touched on a little bit yesterday, is that I'm starting to see a lot of commentary back. It's like, yeah, Lance, you keep saying there's going to be a pullback, but this market's just going, this market's just going to go up from here. There's nothing going to pull it back. It's AI, it's whatever the reasons are. That's normally about the attitude you get when markets are very extended and very overbought. Again, that hasn't changed, and it doesn't mean that you're going to get a correction today, although markets are a little bit weaker this morning. But again, just kind of keep a watch on that. The one thing that we are seeing here, and at least worth kind of paying attention to, is that this angle of ascent that we've had on this kind of rising trend line, again, is starting to kind of taper over here a bit. And again, if the market's going to be a little bit lower today, we're just going to kind of getting this kind of rolling top in the markets. And again, that's kind of something you would expect to see before a bit of a longer correctionary period or a consolidation. There's as we talk about a potential correction in the markets, it doesn't mean that stocks have to actually decline to work off the overbought condition. That's certainly part of it. But one thing that stocks could do is just simply stop going up and just travel sideways long enough to allow these moving averages to catch up a bit. And that's also another way that you kind of work off some of these overbought conditions that exist in the markets. But again, this market is just extremely bullish across kind of all measures. One area of bullishness that we've seen a lot of lately, of course, and this has been since the launch of the Bitcoin ETFs, has been the cryptocurrency space itself. Bitcoin is now having a fairly decent correction. It, like Nvidia, and if you take a kind of an inverse look at the dollar, there's been a very high correlation between these more speculative assets like Bitcoin, like meme coins, like companies like MicroStrategy, etc., that have just gone virtually parabolic in the short term. And this right back here is where we actually launched those Bitcoin ETFs, and that was where the markets really kind of took off. Well, we've had this very, very strong rally, and of course now we've looked like we've pulled a top, and actually have kind of built a head and shoulders pattern here as well. We've taken out the 20-day moving average, which is now going to bring the kind of the 50-day moving average into focus, which is around 56,000 right now for Bitcoin. So there is potential here for a fairly decent correction in Bitcoin over the next few days as we kind of watch. But again, on a sell signal right now, Bitcoin's getting a bit oversold here. So again, kind of maybe expect to bounce before another kind of pullback here towards that 50-day moving average. Unfortunately, the 200-day moving average is at 40,000 for Bitcoin as of right now. Now that'll go up over the next few days. But again, very big gap because you had such a parabolic move in Bitcoin following the launch. Everybody just kind of piled in these Bitcoin ETFs all at once, caused a lot of buying. That's starting to kind of taper off here a bit, that initial excitement. So again, we are starting to see some cooling off in this speculative attitude in asset prices, which again could feed over into the actual major market itself. Just something to keep a watch on right now. And again, but that's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Leibowitz, talk about the upcoming FOMC meeting. Will they raise that dot plot? That's the big question. That's coming up next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So tomorrow is the FOMC rate decision. This is kind of what everybody's watching very closely right now, which is really two things. One, nobody expects a rate cut at this meeting. That's, initially that was priced into the market last year. Remember in October when the market started to rally, the markets were pricing in 5 to 7 rate cuts this year back in November, and they were pricing in a rate cut in March. So the Fed supposedly would be cutting rates tomorrow for the first time. And of course, since then, economic data has come out, et cetera, which has lowered that Wall Street view for rate cuts from 5 to 7 to now being in line with the Fed's, the Fed's dot plots, kind of projections of 3 this year with no rate cuts in March. So nobody expects a rate cut tomorrow. And with the recent inflation data, et cetera, coming out, the Fed's not going to cut rates here. So again, this is kind of an interesting thing because there's a Wall Street Journal out this morning talking about the Fed is playing a waiting game on rate cuts as the rules are starting to change. And, this is interesting because, again, this whole rally, a big chunk of this rally has been on this idea the Fed would be cutting rates this year, lowering those overnight lending rates, reducing interest rates in the markets, lowering borrowing costs, et cetera. So again, that's been a big push for that. And this is from the Wall Street Journal. Officials won't put recession risk front and center this week, yet that risk is likely to drive its thinking over the remainder of the year, leaving it on track to cut rates at some point. The central bank will keep its interest rate at 5.25%, which is a 23-year high when its two-day meeting ends tomorrow at 2 o'clock. So again, we'll have this kind of announcement tomorrow. Again, probably no big change to language, no big change to anything. But the one thing that we'll want to watch, and this is going to be the thing that the markets are looking at very closely, is this dot plot. Do we see, and this is the question I'm going to ask Mike right now. Mike, do you think that we're going to see a change to that dot plot, potentially pushing out rate cuts further into the year, if not even into next year, because of what we've seen lately with still strong employment, an uptick in inflation, et cetera?
I think that's possible. And I also think what we're going to see is a firming up of the dots. So they call it the dot plots because they take the projections of the 12 to 15 members, and they literally plot them as dots. So if someone thinks they're going to cut rates by 2%, that'll show their Fed funds is around 3.25%. And if someone thinks they're not going to do anything, their dot will be 5. So you have this whole range of dots. So I think one thing that's going to happen is those dots are going to firm up. They're going to all come much closer to the median. And I think that sorry, my microphone wasn't next to me. I think that median will possibly move from 3 to 2, but I think a lot of it is just the dots are going to become a lot tighter. Lance, what I'm really kind of focused on is any talk of QT. Mm-hmm. I think that's a possibility that they mention something about it, whether they set a timetable to reduce QT or just say it's on the agenda for the next meeting. I think that'll be that. And like you said, what do they think about not just Fed funds, but employment and inflation over the next year or so in 6 months?
Well, it's interesting because even this Wall Street Journal kind of mentioned that. It says the reason rates are above 5% today is that the world looked different in the summer of 2022 when the Fed pushed them to 5.25%. At that time, officials feared inflation would become entrenched at 3% or higher, which is unacceptably above their 2% goal. The only way to bring it down is through much weaker growth and higher unemployment, which is what higher rates were presumed to deliver. Interestingly enough, that's not happened. And inflation has remained entrenched above 3. It hasn't come down towards 2 as fast as the Fed thought it would. Unemployment rates remain very low. Employment remains very strong, at least from the headlines. And the activity of the markets, et cetera, have loosened financial conditions, which is creating economic demand. So the economic data continues to remain very robust here. So, it is kind of interesting that the Fed's talking about potentially reducing QT with their balance sheet still very large. They haven't done much to reduce their balance sheet by any meaningful size after the increase they did in 2020. Why would they be wanting to slow the rate of QT here? Or, they should be, if they want to get inflation down, they should be increasing the rate of QT to get asset market prices down in order to get sentiment down, to bring down the inflationary pressures in the economy. I mean, they seem to be working against their own end goals at this point.
Well, but again, Lance, we got to remember who owns the Fed.
I understand.
The banks own the Fed, right? So, yeah, you can look at their congressional mandate and it says price stability and maximum employment. And that all sounds great. But at the end of the day, the Fed's goal is financial stability. Financial stability is heavily dependent on liquidity. And one thing that happened during COVID is the Fed did roughly $5 trillion of QE. And when they do $5 trillion of QE, they're releasing massive reserves into the banking system. And those reserves over time are used to create loans, leverage. And now they're taking reserves out of the system. So, first of all, they put too many reserves into the system, and those were excess reserves, and they weren't getting put to use. And that's a good thing. The Fed pulled them out. But a lot of it did get put to use. So now the Fed is starting to potentially come to the point where they're going to pull out reserves when the banks need those reserves. They've already lent those reserves. And that's a liquidity shortage that I think the Fed is aware is potentially coming down the pike in the next, 2, 3, 4 months. They've spoken a lot about it. We see it in the reverse repo program has dwindled down. I think it's $400 billion now. It got up to $2.4 trillion at one point. That's about the best gauge we have of excess liquidity. So I think it's increasingly on the Fed's mind. Again, how are they going to counteract that, right? If they're going to reduce QT, are they going to be more firm with interest rates? Will they actually maybe do some sort of reversal and not raise rates, but say something to the effect of, we are now considering raising rates again, even though we thought we were done? That could be a way to counteract a reduction in QT. So I don't really expect it, but we may see a more hawkish Fed. And if they do something like that, it would be a surprise. And it would be the Fed wanting to surprise the markets and to some degree shock the markets, because we haven't heard any Fed speakers talking about raising rates or that kind of hawkish tone.
Yeah. Go ahead.
So I don't expect it, but it may happen. Who knows?
Well, no, I mean, in this article by the Wall Street Journal, which is written by Nick Timrose, by the way, what officials ultimately do boils down to what problem they decide is easier to fix, a process called risk management. If demand is stronger and inflation is stickier than expected, the Fed could postpone rate cuts. If demand and hiring weaken more than anticipated, they could have ample room to cut rates, but probably won't be able to move quickly enough to forestall a recession. So it's almost as if they've gotten themselves into a really tight corner to where you're either going to create a recession or you're going to create inflation. You've kind of got to pick which evil you want, because you're going to get one or the other at this point. It doesn't seem to be a real ability for the Fed to navigate this soft landing. Again, this is according to Nick Timrose's article, that that trying to nail that soft landing where you don't have a recession but you can bring down inflation seems to be a very tough job for the Fed right now.
Yeah, and they're in another type of bind. Fed policy is extremely tight, right? Fed funds are 2% above CPI. That's the most we've seen in over 15 years. We know that lending standards to individuals, to corporations are tight. Auto loans are now 7+%. Credit cards are over 20%. Mortgages are 7% or so. We know commercial and industrial loans, those are corporate loans, are actually declining. So from that respect, the Fed is doing their job. The problem is financial standards, which really measures markets, stock market volatility, credit spreads, is easy. It's very easy. Stock market's going up. People have money. They want to spend it. So they have these two counteracting forces. And one way to deal with the financial standards is to try to knock the stock market down a little bit, but they have not in any way mentioned that that's something they would do or want to do. But maybe over the next 3 months, something changes to get them to knock financial standards down.
Well, and again, financial conditions are now the easiest that they've been really, outside of a recession, going back really since we kind of started, tracking, financial conditions in the overall market. Of course, that's been reflected in asset prices directly. Again, we have a lot of speculative investing going on in the markets right now. Examples like I was talking about this morning with Bitcoin has just gone, virtually parabolic. We're seeing a lot of the same chases into the meme stocks again. Kind of anything related to AI has gone parabolic. And again, that's just that type of speculative activity that you see in markets when you have too much money sloshing around the system, which is the case right now. I mean, we just still have there, take a look at M2. It's still running well above its long-term trend. So, again, there's just a tremendous amount of money, and not to mention that we just have a massive amount of foreign inflows into the U.S. markets as well. So we have a lot of international countries flowing money into U.S. markets because the dollar is stronger, interest rates are higher here, buying treasuries, et cetera, for reserves. So it's just we've had a lot of stimulus and inputs into the financial markets. But, it's interesting. Bank of Japan just announced that they're ending a lot of their policies that have been supporting their economy. We'll talk about that when we come back from the break with Mike Leibowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yeah.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Been getting a lot of questions the last couple of days about what's going on with the Bank of Japan. How is that going to affect the U.S. economy, the U.S. markets, etc.? Just a quick Wall Street Journal out this morning because the Bank of Japan on Tuesday ended negative interest rates after 8 years and is beginning to unwind most of its more unorthodox monetary easing policy, saying now that the new era of stable inflation is in sight for Japan. Let me just read to you from the Wall Street Journal article real quick. The decision marks the end of a global era of negative interest rates that began in 2010s. Other central banks introduced negative rates. Since then, for generations, the Japanese central bank has served as a laboratory for monetary policy. On Tuesday, it said those policies have fulfilled their roles and the principal ones will be ended. The Bank of Japan will end their yield curve control. They had set a target of 0 on their 10-year Treasury rate. They said last year they'd start to let that rise a bit. It was up to 0.73% on the Japanese 10-year Treasury. They're also going to halt its purchases of assets such as stocks, real estate investment trusts, and corporate bonds that typically don't go on the books of the central bank. That's been hundreds of billions of dollars. The Bank of Japan owns roughly about 80% of their ETF market right now. So they're going to stop those purchases as well. So it'll be very interesting to see, because in the midst of all of this, they've done QE on the realm of about 3 times that of the United States because of the relative sizes of the economies. Japan's been very, very aggressive with all of these policies. And yet Japan is back in a recession now. Inflation remains above their 2% target. They think it'll get down towards 2% in the next couple of years, kind of the status quo of all central banks around the world, that everybody's trying to get to 2%. The question is it going to work? The Nikkei recently set an all-time record after 34 years. And this has been an ongoing process for quite some time. And the question is now, is after decades of all this artificial stimulus, support, et cetera, by Banks of Japan for their economy, can the economy stand on its own 2 feet? And what does that potentially mean for the U.S.? There's a big carry trade between the U.S. and Japan. And that has been going on for years, where I can basically, borrow, kind of short the Japanese treasury and then take those spreads between the Japanese treasury and the U.S. treasury and capture that income. And that's been going on for years. The question is, does all that begin to unwind, and does it eventually have an impact on the markets? Mike, what do you think?
So far, they've taken a baby step. I know it's a change. It's a different direction. This has been widely telegraphed, but keep in mind, they raised rates to 0%, Lance. Mm-hmm. They're still well below every other country, every other developed nation. They are not going. They're going to stop buying REITs, equities, corporate bonds, and they're going to stop yield control. But they're still going to be doing QE, so they're still buying bonds. And I think what that is a threat to the markets that if you push our yields up, we have QE, we'll push them down. And even though we're not targeting a specific rate, I think the last cap on their 10-year bond was 1%. They said if it gets to, we won't let it get to 1%. So my guess is they still have that kind of cap in mind. They're just not public about what the cap is and when they will fight it. So for now, it's a move. It's a move in the right direction. Like you said, it's been a monetary economic disaster in Japan for the last 35 years, recovering from a bubble that makes any bubble that you think we've had in this country tiny. Their bubble was massive, included both real estate and stocks. And they are slowly working their way out of it 35 years later. But this is a baby step. If they continue down this road, it has much bigger implications, not just for Japan, but more importantly for the rest of the world. They are a massive exporter of capital. They're individuals, pension funds, corporations, all send their money, not all of them, but they send their money abroad, because why invest at roughly 0% when you can earn 4, 5, 6% in so many different places? So Japanese capital has bolstered financial markets, asset prices. And like you said, Lance, the carry trade is massive. It's estimated to be around 20 trillion. Could be a little more, could be a little less. Basically, investors, including many U.S. investors, borrow yen, and then they sell the yen and buy dollar assets, and they're basically short their yen and short the yen with a near zero borrowing rate, and they're buying assets, whether it's treasuries or stocks or whatever they're investing in, and earning 5+%. The risk to that trade is that Japanese interest rates go up, so they're not borrowing at close to zero anymore. And I think that risk is relatively small, at least in the near term. I think the bigger risk is that the yen rallies, because when you do the carry trade, you're short the yen. Right. That's kind of implicit in the trade. So, it's great that you can borrow at zero and invest at 5, but if the yen moves 3%, if the yen appreciates 3% versus the dollar, your 5% gain just fell to a 2% gain. So I think the risk to not to sound dire, but a potential headwind to global markets, and much more so the U.S., because that's where a lot of that money comes, is if the yen starts rallying decently. I think a lot of people will pull back on the yen carry trade, and that may stymie the flow of funds to markets. But for now, I don't. This was widely expected. We'll see if they keep going down this path. Then it may change my opinion. But for now, this isn't much. We'll see if they do more, though.
Yeah, and again, it is. I've just gotten a lot of questions about this, and kind of the immediate knee-jerk reactions is like, oh my gosh, if they're going to do this, what does this mean? For Treasury yields in the U.S. Does this mean interest rates are going to go up sharply, et cetera? And again, this is a very small baby step. And again, their yields are still below 1% and have been there for years because them, just like us, we can't really afford higher interest rates for longer because of all the leverage in the system. And on a relative basis, their system is more heavily leveraged than ours. And so this is, higher interest rates become problematic very quickly for their economy, just like they are going to be problematic here. As interest rates go up, economic activity is going to slow down.
They also have a much bigger demographic problem. Their population is declining. They do not easily allow immigration. And their population is also top heavy by age. So there's a few younger people supporting a lot of older people. And that's a huge, for them. For us, population is still a tailwind for growth. Immigration does help economic growth. And just the age structure of the U.S., we are still getting positive economic growth from our structure. And that should continue for at least 10, 15, 20 years. Japan, they have a headwind that's getting stronger and stronger due to their demographics, and they don't want immigration, and the younger people don't want to form households, have babies for numerous reasons, largely that they've been in a recession, depression, economic funk for 35 years. It's not really conducive for great sentiment and an outlook that says, I want to have a lot of babies and I feel comfortable supporting them. So, Japan has much bigger problems than the U.S. And like Lance, you said, their leverage is much, much more than we are. The government debt, I think, is almost 3 times. Debt to GDP that we are 2.5 times. It's about
It's about 240% of debt to GDP versus about 120 in the U.S.
Right, so 2 times.
Yeah,
2 times.
It's still a lot.
Right. Well, what it means is fiscal dominance.
Yeah.
It means that as much as the Fed has to help our Treasury, their Bank of Japan has to do so much more to help fund the debt.
Right.
So, will they raise rates a lot? I doubt it because they can't afford it.
Yeah, and again, this is, and again, when people talk, there's, when you see videos and people putting out commentaries like, oh my gosh, because of the debts and deficits in the U.S., it's going to, this means a major, economic revulsion is coming, et cetera. And it's just, if you want to know how long a country can go with increasing debt to GDP ratios, just take a look at Japan. They are a microcosm of where we eventually end up. And, you can issue a whole lot more debt than you think. If you think we're issuing a lot of debt now, just hold my beer, because we're going to be issuing a lot more debt in the future as economic growth rates continue to slow because of the debt. But again, that debt to GDP ratio can be much higher than you think, and things still operate and function because of, it's not just us, it's everybody in the world. Everybody's doing exactly the same thing. So speaking of that, though, we'll come back and talk about a new form of QE. Mike's latest article will be out tomorrow, but we'll give you a little bit of a preview when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So coming out tomorrow will be Michael Leibowitz's latest article, and always comes out on Wednesday. Usually we talk about it on Thursday, but since he's here a day earlier this week, we'll give you a bit of a preview, talking about a new form of QE. So again, just because we think about QE, quantitative easing, and traditional measures, which is basically the Federal Reserve buying bonds and putting it on their balance sheet and then sending the remittances back to the Treasury. So there's this cyclical washing of tax dollars. That doesn't mean that's their only option. And so, Mike, you kind of started talking about yesterday the kind of this new form of QE. They'll be in your article tomorrow. What's that all about?
So first of all, this is just based on kind of rumors, hearsay. The Fed hasn't said anything about this. They haven't set Nick Timrose to this. That's in the Wall Street Journal. So, this is conjecture. Let's talk about what QE does. QE buys Treasury bonds from the banks. In exchange, the banks get reserves. The banks use those reserves to make loans, to buy assets. So they're giving banks reserves. Banks can use those reserves to do a lot of things, but one of those things they can do is to hold more U.S. Treasury bonds. So QE in that respect helps the U.S. Treasury market, right? It helps absorb more bonds that the Treasury is offering. Second, and this is just as probably even more important, they're taking bonds out of the market. They're removing bonds from the market, so there's less supply, also allowing the Treasury to issue more bonds. So QE is great. Not only does it have the monetary effects the Fed likes, but it helps the Treasury borrow even more and more money, right? That's a wonderful thing. The more debt we have, the better, according to Washington. But there's a huge problem with QE, and it's thought to be inflationary. And we can debate that all day, whether it's inflationary or not, but it doesn't really matter. Because if the market thinks it's inflationary and the Fed were to just say, we're going to do QE to help the Treasury out today, inflation expectations would rise rapidly, which can feed into real inflation. So the Fed can talk about reducing QT. They can talk about slightly reducing interest rates, but they're so far from QE at this point. At the same time, the Treasury is just issuing a ton of debt, and there's concerns that once they kind of blow through this excess liquidity, that the Treasury is going to be sopping up liquidity from the markets and causing dislocations in, many markets. It may cause problems in the Treasury markets, but they may actually cause bigger problems in real estate or stock or, name the asset market. So what can the Fed potentially do? And again, this is kind of rumor, but one thing they could do is tell the banks, especially the most important banks, that they can buy unlimited amounts of treasuries. Right now, banks are limited. Their leverage ratios, capital ratios, in how much of an asset they can hold versus the capital they have. So they have a limited amount of capital. They can buy a limited amount of treasury bonds. Now, the capital rules are skewed so that riskier products, you need to hold more capital. So maybe they can hold for every dollar, $5 of a treasury bond, but only $3 of a junk bond or a mortgage, a non-Fannie Mae, Freddie Mac mortgage, something like that. So what they could do is say there's no more leverage ratios for treasury bonds. That would be great. The treasuries could buy more and more, but they're still limited in their funding. They still need funding. They need deposits or some other source of funding to buy treasuries. Well, one thing that they could do is resurrect the program that just ended a week ago, the BTFP program, which was put in place to help regional banks a year ago. Banks in general. Banks could basically pledge collateral and borrow the money. So if I have a treasury security, say it's even 80 cents on a dollar, I can pledge that to the Federal Reserve. In exchange, they'll give me its par value, which is $100. So I can do that and get funded. So what if these big banks could take these treasuries they just bought, go to the BFT program, fund them? Now they have funding. Now their only risk is that the bond prices fall. But the way the BTFP program was structured, it doesn't matter because they're going to keep funding you at 100 cents on the dollar. And the way that accounting works is that you don't have to realize any gains or losses until you sell the asset. It's held to maturity accounting. So in theory, banks could have massive losses on treasuries, but as long as they can fund them profitably for the bank's good. And they could own, in theory, as many treasuries as they want. So it's kind of a stealth form of QE. And yes, the BTFP program goes onto the treasury's balance. And yes, it increases their assets. But the market doesn't think of it as QE as they do traditional QE. So, again, it's rumor. Will they do it? It sounds like the kind of thing they would do in an emergency. And just push through, just like they did BTFP about a year ago. But again, if you think that the Fed will not help, that the Fed can't help the Treasury, you're grossly mistaken. The Fed will do whatever it takes to make sure that the Treasury will fund its debt and fund it, not just fund it, but fund it at relatively low rates.
Right. Well, and again, the question becomes, for investors is ultimately, does this provide liquidity to the markets to where, asset prices keep getting supported and you have a boost to liquidity flows, et cetera? Because again, QE is in a vacuum by itself. If it truly was just increasing, the bank's credit at the Fed, and then the banks would loan that to businesses in order to do, build out a property or build out a plant, whatever it is, that's one thing. But what we know is that money gets recycled through leverage back to prop trading desks, hedge funds, et cetera, which winds up in the financial markets. So the question is, does this new form of QE get used in the same manner?
Yeah, because, think about it. Let's just talk about that first part. If they don't have to hold capital for treasuries, they have a whole bunch of unused capital at this point.
Right.
They can lend it to the economy. They can lend it to corporations, to individuals, and as we're seeing today, they can lend it to speculators. That seems to be where a bunch of the leverage is going today. It's not going to the economy. It's not going to individuals. So, yes, it has the potential to boost economic growth. It has the potential to feed the markets, and it has not the potential, the ability to fund the U.S. Treasury, to run deficits, which then help the economy and create more leverage.
Well, and again, I think it's important that we also don't rule out QE as well. If
right.
Considering that we are now just ramping up the amount of debts and deficits that ramping up the deficit, which requires more debt issuance, that the Fed is going to have to continue in the future. And again, I kind of rhetorically asked you earlier, is like, the Fed's QT really didn't reduce their balance sheet that much. They really can't. And because of this whole need of having basically a buyer there for this issuance of debt, and the more that we have to continue ramping up debt issuance to fund spending programs from government, et cetera, the Fed's going to have to continue to monetize, up to 30% of that debt issuance, and particularly in the future, that's just going to continue to ramp up the Fed, the Fed's balance sheet. In fact, by 2030, 2040, 2050, we could be talking about a Fed. Hopefully I'll be dead by then. Be talking about a Fed that has a balance sheet of 30 or 40 trillion dollars of bank assets.
Yeah, we started earlier with the Bank of Japan.
Mm-hmm.
And there's nothing that says that we're not on that we're on, I don't know where I was going with that, but we're on the same path.
Yeah. Well, no,
it's the same path, and we're probably going even quicker.
Yeah, and it's not, but again, importantly, it's not just the U.S. It's the Eurozone. It's every other central bank in the world is doing exactly the same thing. Every central bank has a target of 2% inflation. Every central bank is doing QE. Every central bank is controlling their interest rate to some degree or manner. And, and other central banks right now have already started cutting interest rates. We're kind of the laggard in the group, which means we will cut rates and we will play catch up at some point to every other central bank in the world.
Right. And the effect is very negative from it. It drags on economic growth. And unfortunately, not only are we following Japan with QE and monetary policy shenanigans, but we're following them with economic growth and potential. Mm-hmm. And look, like you led with, Lance, Japan's rates have been at zero for like 8 years. That's where we're going. Everything we're doing is just pushing rates lower and lower. I know it all seems unsustainable in a Ponzi scheme, but part of that Ponzi scheme is to get rates to zero over time.
Right.
When it's needed.
Yeah, exactly. All right, Mike. Well, thanks a lot for joining us today. He'll be out on Thursday, so you'll be stuck with me on Thursday. And then, so there you have it. But be sure to go by the website. The article on buybacks is on the website now. The article on the new form of QE from Mike will be on the website tomorrow. So again, generally, stuff we talk about on the show, we generally write an article about, so you get all the attendant charts and graphs and details, etc., on the website, realinvestmentadvice.com. While you're there, send us your questions and comments, emails, whatever we can do to help you. Make sure and like this channel. We also appreciate if you'll like and subscribe to the channel. It helps us as well, and we appreciate all that you do for us. All right, have a great day, and we'll see you back here tomorrow for the Wednesday edition of the Real Investment Show. Danny Ratliff will join me in the morning. Have a great day.